Hello, everyone, and welcome to the Hospitality Edge podcast, where we bring together what we think are two sides of the same coin, real estate and hospitality. As we get closer to the end of this second season, I've been thinking about the incredible things and the incredible stories that we've shared on this podcast. And we've heard from entrepreneurs who started with nothing but a handwritten letter and built companies managing hundreds of properties. We've learned from investors who found creative ways to unlock capital and ownership when the usual doors were closed. And we've met operators who reminded us that even in a tech-driven world, hospitality still comes down to the people, the teams you build, the relationships you nurture, and the experiences you create. Today's episode brings all of those lessons together. These are some of the conversations that stood out in this second season of the Hospitality Edge podcast. These are the ideas that made us pause, the strategies that you can carry into your own business. If you've ever wondered what it really takes to grow and thrive in this hospitality and vacation rental industry, through the wins, the mistakes, and the moments where everything almost breaks, this is for you. Let's get into it. One of the things that struck me the most this season was how different people approach growth. Everyone has a vision for where they want to go, but the path to get there rarely looks like a straight line. We talked to operators who figure out how to adapt every time the game changed, whether that was scaling their systems, refining their operations, or learning how to get the right people on board at the right time. The common thread, relentless action. These leaders didn't wait for perfect conditions and they didn't get paralyzed by setbacks. They built momentum one step at a time, and when something broke, they fixed it and kept going. As you listen back to these stories, think about the moments that feel familiar. Maybe it's the early days of trying to win that first homeowner. Maybe it's the challenge of going from 10 to 50 properties and realizing the way you've always done things won't work anymore. Or maybe you're further along and you're asking, what's the next leap? Wherever you are, these lessons will resonate. So let's start with Dana Moraro's story, a perfect example of what it means to build from the ground up. How do you find your first few owners? What's your first few hires? Is it just you at first, or did you have your husband helping? What were you trying to focus on at that stage?
It was not easy. Starting with nothing, I got a list from a realtor friend of homeowners in the area. I put out 5,000 handwritten letters. The pamphlets were not handwritten, but the addresses, I had them all handwritten so people would be willing to open them, right? And from that first batch, we got one homeowner. They gave me their apartments, and then I got this new homeowner. And the next thing I know, I have 3 homes now on my website. So then little by little, things started moving. For the most part, after that point, everybody that we onboarded was found us through the website, investing in SEO. It's been to this day, it's definitely at the front. We do get about 40% of our bookings direct because of it.
Do you think there was a before and after deciding that you needed to scale faster because that now there was this financial pressure? When you're starting out, how did you start to make that transition towards setting the foundation for something that could actually scale to the level you did?
Our original goal was to get to 100 properties. And I had it all mapped out. I was like, we get to 100 properties at 10,000 a property, we'll make $1 million a year. A 10 to 15% profit off that, we'll make $150,000, $200,000 a year. We'll be doing great. Somewhere about 75, the light bulb went off and we were like, we're really good at this. And we went from 75 to 135. It just started rolling and we found our niche and we're like, why would we slow this train down? But it's also been the life lessons that we have found that at every 50 properties, your process breaks. Everything that you thought worked, everything that you had mapped out, it breaks. And then you have to go in and reevaluate and fix it.
If you were to start your property management company that now has close to 200 properties under management all over again, what would you do differently?
Paying more attention, having more insight and thought behind how we structure our financial systems, our accounting systems. With short-term rentals in particular, there is a massive volume of transactions and it increases exponentially. You have to have a really clean ledger. Looking back, I should have been way more thoughtful and intentional on how I approached the financial structure because it's been very painful for us as we've grown.
Have you found a solution as far as a vendor, technology provider, process?
This is the thing I regret, the mistake I made. I outsourced the building of our financial systems to a third party company, as we grew and we were growing fast, we started having more of these errors. And within about a year and a half, we realized this partner cannot be with us because they're making so many mistakes. And so we went through the process of ripping them out and rebuilding everything on our end.
On the PMS side, if your vision is to scale, should you go straight for the scalable solution, even though it's way too expensive versus what you could get that solves every single checkbox today?
It's tricky. When we went to Verma for the first time, we ended up talking to everyone there, all the other property managers, and they're like, oh, I've switched from Guesty to Track. I've switched from Streamline to LMPM. I've switched from Hospitable to Hostaway. They're all jumping around, and it's such a waste of resources. Every time you're doing that, you're moving laterally, not forward. And so we were trying to build everything with just API integrations off of the PMS. I don't want to store all this data in there and then have to try to extract it all back out. It's always a blend of what can you buy off the shelf and what can you build yourself. And then how much can you do in between that is the least amount of work, but might get you the most leverage.
You find that apartment building that was your way into short-term rentals from nothing to 115 properties that you own. What allowed you to scale to that level?
I bought my first rental property at 20 years old. What really gave me the jump was getting into multifamily. You can only grow so fast doing single family homes, and your return's only so good. There's such a higher amount of gain when you get into the multifamily route. It's really interesting because as you invest, you build this sense of confidence that you can do it. When you say, oh, 115 units, that sounds so crazy. But when you buy one unit, you feel comfortable buying a second. When you have 2 units, you feel really comfortable doing 4. And when you buy a 10 unit, you really feel comfortable buying 50 more. You're like, oh, I can do this. This isn't something that's mind-blowingly crazy, or I don't have to be a super genius. And you just have to have that confidence in yourself.
When you listen to these stories back to back, you can feel the common themes. Growth is exciting, but it's also messy. Systems that work at 5 properties might completely fall apart at 50. The market will test you, your team will stretch, and sometimes you'll feel like everything is breaking at once. But what we've learned from our guests is that this is normal. The key isn't to avoid the challenges, it's to keep building even when it feels uncomfortable. That willingness to adapt, to iterate, to do the hard things when nobody's watching, that's what creates the kind of businesses we admire most. And here's the other thing many of them pointed out. Growth only works if the foundation is strong. You can add properties all day long, but if your financial structure and your operational structure isn't set up the right way, you'll burn out very fast. So in the next set of clips, we're shifting the focus to the decisions that set you up for long-term success, creative financing, ownership strategies, and the money moves that separate the businesses that last from the ones that don't. If there's one thing that we've heard over and over this season is that growth without a strong financial foundation is a recipe for disaster. You can be great at operations, you can deliver an incredible guest experience, but if your capital structure isn't right or you're taking on deals that don't make sense, the whole thing can collapse under its own weight. The leaders we spoke with this season all had different approaches, but they shared one core belief. Own your numbers, own your future. For some, that meant finding creative ways to unlock capital when traditional financing wasn't available. For others, it was about choosing ownership instead of management, even if it meant moving slower at first. And for some, it was the discipline of walking away from deals that looked shiny but didn't fit their long-term strategy. As you listen to these next stories, notice how intentional these decisions are. These entrepreneurs and investors aren't just hoping things will work out. They're thinking 3, 5, 10 years ahead and structuring their business in a way that gives them control, flexibility, and staying power. What are the things would you say you see a lot on the writing part specifically? I'm curious around the capital structures, the whole financing of it all when you're looking at this large scale development.
Every deal is unique and different. Some deals have access to government incentives, whether it be local or federal. Obviously plays a big role in financing these type of properties. That'd be one of the first things that we'll help with is seeing what government incentives are available in those markets and for that type of property, because that'll drastically change the way that we would approach a cap stack. The other thing that we would typically look for is that a state in which you could use usable deposits as part of your equity stack. You could very much drastically lower your peak equity requirements by having healthy sales deposits that you could put towards equity on the project to lower your debt needs.
You talked about three strategies. There's the owner earnout, the seller financing, and then what was the third strategy?
Upfront capital, home payment.
And what's the difference between owner earnout and traditional seller financing?
A seller financing is really a sort of a mortgage or a note secured by the business itself. It has a fixed interest rate and a fixed payment schedule, no matter what happens to the business, right? Owner earnout has everything to do with the business in terms of what cash is remaining at the end of the day. And so usually a company that cash flows will have some cash remaining and it could be distributed to the owners. So in earnout, a seller becomes one of the folks that get a profit distribution. And that's how they are able to get what they expect out of the sale.
So in other words, if there's no profit, there's no distribution, they don't get paid. You mentioned earlier that there were two particular investment theses that you were looking at on the motel side, independent hotel, motel, where you see a lot of opportunities in, and how are you going about it?
Independent hotels and boutique hotels are essentially hotels that are a little bit smaller. They're not affiliated with a franchise brand. They tend to be 10 to 100 keys. They are within 2 hours of a large metro, a commuting distance. They are a little bit more leisure oriented. We add value in typically in about three ways. One is the immediate digitizing and tech enabling, where normally these types of hotels take reservations by phone or check. They don't have a true multi-channel dynamic pricing mechanism, and that's where our strengths lie. The second is the labor. They either do it themselves or they have someone at the front desk and maybe others. Given our kind of tech stack, of course, we have on-site labor as well, but we're able to reduce some of the labor requirement using technology. And then third, cosmetic upgrades, making it modernized, making it more unique, repaint, or change the floors, do something different.
What's different about this kind of deals from a financing perspective
Oh, yeah.
versus your traditional multifamily deal?
Because a lot of banks don't like to lend on these types of assets, it creates the opportunity to seller financing as part of the offer to purchase. So we ask the seller to carry a portion of the price through a loan. We typically don't do earnouts from this, but we typically do a regular seller finance note. Some of them happen to be fairly favorable for us in terms of the interest rate, term, prepayment penalties. We keep it simple, but it tends to be pretty good in the sense that it's a little bit more favorable than working with a bank. That's an opportunity from an investor standpoint. There's less the need to go to the bank. A lot of times the seller will finance it for us. And that really helps us structure it in ways that we really want to be done for the deal.
If you could give some final advice to someone that wants to replicate the success you've had in this space.
To get out of the MVP stage earlier, I feel like I've been forever testing and trying because it's really important for me to really get it right. And as the world changes, then some of the learned things are almost irrelevant. So you end up having to relearn. Anyway, so the advice would be to go big right away to the extent that you can. On the flip side, try to be a bit more diligent and discerning with your approach. A lot of times people end up getting caught up in the hype, following the gurus, but understand end user demand flows and supply flows as well as capital flows. And when you feel like you have a good understanding as far as trending goes, then you can develop a strategy and comfort around that.
What do you think is the most difficult part of transitioning from being an operator only, a property management company only, to going into the actual real estate game?
We did start acquiring our own homes and we were managing those. To actually go into the day-to-day operations, it was pretty daunting, right? I quickly learned that I needed to bring in some strategic people to really help me really get this company rolling the right way. And my wife was in a position in her career to start dedicating full-time status into our company. We're actually trying to build a hospitality brand around the Broussard name. We have property management, we have the fund. I'm in a position to grow this into a legacy business for my family. The Broussard Properties, Broussard Fund can be a boutique standard on its own. It is profitable, makes money, provides excellent experiences
for his guests and buys incredible assets that we know are going to grow in value. And so all of it has come together, has been really exciting. It's turned into a dream.
A lot of those big hotel brands started by owning the assets, and then they realized that if they wanted to scale, they had to let go of the ownership and start focusing on other models, either the management or the franchising. Why do you think that on the vacation rental side, it seems to be start managing, get the cash flow, and then focus on buying?
We're trying to buy vacation rentals in markets that make sense, right? We're not out scouring the ground in Park City, Utah, where vacation rentals are at absolute premium right now. They're way overvalued. We're in markets like Augusta, Georgia. So you've got a good asset at a good value. The cash flow that you're going to generate on the business is going to make you cash flow positive. The other thing that makes sense is you have a very interesting tax advantages when you're buying these assets. We're writing a big piece of this house off every year, but to the extent that we can,
Let's say you're working on pricing a property. What's your approach? Can you tell us a little bit about the fundamentals of pricing the short-term rental asset?
I always recommend having a real estate lawyer and a CPA on speed dial. So ROI is your return on investment. How much are you putting in and how much are you going to get back and how fast is that return going to happen? With short-term rentals, generally your first year, you're riding the line or you're going to be dipping into the red a little bit. Your second year, you flatten out. Your third, fourth, and fifth year, you start to make some money and you really make money on them when you go to sell them. If it's earning $10,000 a year, you paid $100,000 for it, that's a 10% cap rate. Anybody out there promising you cap rates at 10% and don't have actual rental revenue as proof for that specific property, they're selling you a dream.
What it is that owners should be educated on. There's owners that want to know everything. There's owners that just want to receive their money and make sure that everything is taken care of. What's been your approach and what does that look like on a day-to-day basis?
It really depends on what their end goal is. Are you looking to build a portfolio or is this an investment piece? And how involved do you want to be? I see a lot of it on social media a lot, like, oh, you're going to make X amount of revenue. Yeah, but you also have a cost to own. What is your note on your house if you have a mortgage? What is the insurance? What are the HOA dues? People don't usually think of how many linens and spoons, forks, knives, all of that stuff. Those are all business expenses because you're running a mini business out of these. There's stuff that's going to break. There's stuff that's going to go missing. And because you're providing a service, you have to replenish that. So there's a lot of education on what a total cost to own is. The easy, very generic ways to say your cost to spend is going to be between 8 and 10% a year for maintenance.
What are some things you would say are red flags that would tell you this owner is just not a good fit?
I always ask them, do you feel lucky? Do you like to play poker? And if it's absolutely not, I don't like risk and horrible, do you watch the stocks? Do you invest in the stocks? If you're okay with that kind of up and down short-term rentals, you have to have some grit in this industry. That owner has to be okay with last minute stuff. Long-term rentals is more steady and safe. Short-term rentals, it's a gamble sometimes. And then I start asking what their hard lines are. What is your absolute, you don't want pricing to be below this amount. And if they have some astronomical price because they have an emotional attachment to their house, we're probably not going to be a good fit because I'm not going to keep disappointing you.
The thing I love about these conversations is how grounded. The thing I love about these conversations is how grounded they are in reality. There's no hype here. Nicholas, Farhan, Michael, Taylor, they're all showing us what it takes to build businesses that last, even when the market shifts or financing gets tough. One takeaway that stood out to me is how often ownership came up. It's easy to stay in management because it feels lower risk. But as Michael Brousseau reminded us, ownership is the ultimate unlock. It's what builds equity, opens up tax advantages, and creates the kind of security you just don't get when you're building someone else's asset. But as Michael Broussard reminded us, ownership is the ultimate unlock. It's what builds equity, opens up tax advantages, and creates the kind of security you just don't get when you're building someone else's asset. And even if you're not in a position to buy right now, the way you think about deals matters. Are you structuring them in a way that gives you flexibility? Are you educating your homeowners so you're on the same page about returns, expenses, and the realities of this industry? Those decisions ripple through everything you do. Now, money and ownership matter, but the heart of this business will always be hospitality. And the companies that thrive for decades are the ones that never lose sight of the people, their teams, their guests, and the communities they serve. Let's go there next. We've talked about growth, we've talked about financial strategy, but the real heartbeat of this industry, the thing that separates the companies that survive from the ones that lead, is hospitality. And that word means more than guest amenities or well-designed properties. It's about the way you treat people, your team, your homeowners, your guests, the community around you. It's the human connection that no technology can replace. This season, we heard so many reminders of how powerful that connection can be. Chris Morton showed us how even in an increasingly automated world, guests still crave real human touch. Dane shared how trust, not just pricing strategy, is the foundation for building lasting homeowner relationships. Chad and Shannon reminded us that the brands with staying power are the ones who refuse to compromise on quality, even when it would be easier to make, Chad and Shannon reminded us that the brands with staying power are the ones who refuse to compromise on quality, even when it would be easier to take on more volume. These stories reminded me that no matter how advanced our systems get, hospitality will always be a people business first. What do you look for when you're trying to bring people on your team that are going to be guest facing?
First and foremost, it's really about getting a feel for someone who has the right attitude. I mentioned the word earlier, servant's heart, and then really combining that with a problem solving mentality, because that's ultimately what we're doing when you're facing guests. Beyond that, when we do training, we talk about building rapport and building those relationships with guests. It's all about being able to speak to a guest, find out what their needs are, remembering their name when they speak to them, really treating them in a way that they'll never forget, make them feel special. That's kind of beyond the right attitude. And lastly, being able to network out into the community, building rapport with local businesses. That's just a great way to build relationship skills. If you have someone like that that's willing to go through that journey with you, you're going to have a pretty successful concierge, a type of person working for you. The way that we've built our product is we do have the digital solution. Guests can book things right on the digital app that we create for the properties that we work with. But we also believe that hospitality is about personalized service. And to us, personalization means actually being able to talk to a human being if you want to, because it's great to be able to book something on an app. But what if you have a question about a boat rental or something like that? I don't think that you can just force everyone into a digital only AI only experience. We are combining the best of technology with the warmth of the human touch. And again, we recognize not everybody wants to talk to somebody, but there's others that actually like to speak with a live person. So our vision on that is most people are dealing with voicemails and endless call loops in the workday every day. And we want to be that breath of fresh air where they actually push call and a live, happy, friendly person picks up and talks to them about how to make their vacation better. We're melding technology with personal touch.
When you're looking at having a team that you have to train on these same standards that maybe are very common sense to you, but not necessarily so to them. So what has been your approach and how has that approach evolved with time in terms of ensuring that that quality is maintained?
It's definitely being hands-on and training your team properly. Every week, I will go through our review and see what is it that the guests are saying. And then we meet with the team and we go through the same. Hey, how was last week? Is there anything that came up? If we notice a pattern, obviously it needs to be fixed. And then we keep on top of that because certain things only come up certain times, right? We have certain things that happen in the winter that don't happen in the summer and vice versa. So keeping communication going with the team, keeping everybody in a cohesive environment helps quite a bit.
What did you have to do to make sure that your owners understood the importance of giving you the pricing flexibility that you need to actually book their properties? A lot of property managers think, oh, I'm just going to go into luxury. It's going to be amazing. But then they realize that the owner is setting a minimum rate that is super high. How did you approach that?
When you take on a new homeowner, there's the education piece that comes with it. There are people that have done this before, so that part's a little bit easier. You just go into how you do things compared to other companies, and then into revenue management and what the expectations should be. And then when you have a homeowner that's never done this before, the education is completely different. Probably takes months to bring that homeowner up to speed. There's a lot of questions in the beginning, and it's an emotional part, and you got to understand that and relate it.
Going back to
So-
human to human, right? Understanding that
Exactly.
you're all talking with a human being and they're feeling certain things. When you look at your business and everything you've accomplished throughout the last 12 years, if you were talking to the Dana that was starting this business 12 years ago and you could tell her, don't make this mistake, what would it be?
Don't run after the new shiny toy when it comes to technology and your tech stack. Take the time to evaluate everything and make sure that it's the right tool for you. And don't just add things because they can solve one problem. Make sure they solve many. When you have a call with a salesperson, oh, yes, it does this, and yes, it does that, and it does the third, and the second, and the fourth. And then you don't find out of certain things until you actually onboard, right? So doing your due diligence and really diving into every aspect.
Most operators eventually conclude that it's just impossible or unrealistic to keep up with that kind of quality at scale. What are you doing differently that has allowed you to maintain that 4.91 average review score, even with 100 plus properties?
I think there's a couple reasons. We've taken the mindset from the very beginning that if somebody books a 3-day long weekend and some stuff goes wrong, I just ruined 10% of their vacation time. A lot of operators have focused on growth rather than quality. I could easily be twice the size that I am, but we turn down about 80% of what comes to us because they're just not a good fit. A lot of people have just taken whatever they could, and that has backfire spectacularly because you don't have time to circle back to your properties you've had for 3 years and make sure they're staying fresh. We have junior ops managers who are responsible for a subset of properties, and they're in there every 45 to 60 days stocking them, making sure that the houses still look good.
So you scale the arbitrage model more or less to what level, what kind of size?
2019, I had a whole bunch of friends that worked on Wall Street that owned homes in Martha's Vineyard and in the Hamptons. Someone knew that I was doing this, like, hey, I need a property manager. And I was like, all right, I can do it. I'm doing it for myself. And it just word of mouth. I've never actively advertised. All of my business has been word of mouth. My clients are the owners that come to me because they heard of me from another owner. I kind of take pride in that. Now, am I going to explode into 200 property company? No. And guess what? I don't want to, because I can be very selective about the owners that I take on. Because in this space, you could have a property that's only bringing in $100 a night. You could have a property that's bringing in $1,000 a night. It's pretty much the same work. It's about being smarter.
What is it that you're looking for when you're trying to audit the business to see what's wrong and what needs to be fixed?
It's just really a questionnaire that's given to any of the team members that the executive deems relevant, that they should take it. And that also gives us a sense of how does the executive or the founder thinks about the people that are working with him, right? Do they look at them from a vantage point where I'm looking down, or do they look at them as peers? We immerse ourselves into the operations to see, do these processes make sense? Can I follow the thread of the operations and say like, oh, because this was done, this happened. Whenever you see the chain breaking, now we have somewhere where we can start, and then we just continue going and trying to mend the chains. If it's something like we have to let go of someone, or we have to bring in a new team, or the executive has to have a little change of heart or a little change of mindset.
Instead of what do I need to do, how do I need to do it, move that mindset towards who is the right person to do this function. You can start thinking more strategically, more long term. You can focus on areas that have more leverage.
I think a lot of business owners just have to check their ego in the door. A lot of them are very concerned with, no, I'm the CEO and I'm the whatever, I'm the president. You're the CEO of a one-person company. Come on, man. You're a founder. You're a business owner. When you develop a C-suite and you have an executive team, 20, 50 people under you, now you're specializing into that CEO position. You're capital raising. You're setting up long-term vision. You're making sure that everything's administrated the correct way in terms of finances. I think that's one of the things that hold a lot of people back. They don't really check their ego at the door.
You mentioned being on hundreds of distribution channels, and I hear two schools of thought. There's those that think, let's be on the most important ones, let's not even look at anything else. And then there's you, right? Wanting to be on as many as you possibly can get yourself.
When I say we have hundreds of connectivity partners, not all of them are leveraged at every property. We want to look at putting our efforts, our marketing dollars, and our time into the ones where we're going to get the biggest returns. So every property we go into, we identify what will be the most lucrative channels. And maybe in the first year of opening a property, we might deploy more just to test that out further and then see which ones kind of hone in and become the top performers. I would say on average, we probably have about 30 channels to 40 channels per property, the primary booking channels at each individual resort.
Hearing these voices again, it's clear. The best in this industry, hearing these voices again, it's clear. The best in this industry build more than businesses. They build relationships, they build trust, They build experiences that guests never forget and teams that are proud to deliver them. And that's really what we set out to explore this season. How the worlds of real estate and hospitality come together. You can have all the properties and all the capital in the world, but if you don't care about the people at the center of it, you won't last. This season reminded us that the strongest companies don't chase shortcuts. They're intentional, they lead with clarity, authenticity, with a human approach to things, and they hold themselves to a standard that goes beyond revenue. As we close out this episode and this season, think about what you want to build. Not just the number of doors or the size of your portfolio, but the impact and the kind of business that you want to build. That's what makes this industry worth it. All right, just to wrap this up, this is not another episode, but another incredible season of the Hospitality Edge podcast. Thank you all for following along. Thank you all for listening. Putting this together reminded me just how much we've learned from the guests who shared their stories with us this year, entrepreneurs who showed us the grit it takes to start from zero, investors and operators who opened up about the tough financial decisions that ultimately set them up for long-term success, and leaders that reminded us that at the end of the day, hospitality is about people, the teams we build, the guests we serve, and the relationships we nurture along the way. My hope is that this season gave you something more than just information. I hope it gave you perspective, inspiration, maybe even a nudge to take the next step in your business, whatever that might be. And if you've been listening and growing with us, thank you. This show wouldn't exist without you. We've got big plans for the next season, and I can't wait to share them with you. But for now, on behalf of the entire team here at the Hospitality Edge, thank you for being part of this community. I'm Sebastián Muñoz. Until next time, keep learning, keep building, and keep raising the standard of hospitality and real estate.